Basics of the stock market. All you need to know. Hey everyone, welcome to our channel. If you're new here, welcome, and consider subscribing to my channel and click the little bell notification below. So what is the stock market? To go from an idea in an entrepreneur's head to an operating company, they must lease an office or factory, hire employees, purchase equipment and raw materials, and establish a sales and distribution network. Depending on the size and scope of the business, these resources necessitate significant capital. One can obtain funds by selling shares, aka equity financing, or borrowing money, aka debt financing. Debt financing can be difficult for a startup because it may have few assets to pledge as collateral for a loan. Moreover, the loan's interest would be a financial burden in the early days, when the company might not have any revenues or earnings. That's why equity financing is the preferred option for most startups in need of capital. They do it by selling stock to the general public in an initial public offering. This changes the company's status from a private firm with a few shareholders to a publicly traded company with many members of the general public holding shares. Now, it might be clear to you that a stock is a financial instrument representing ownership in a company or corporation and a proportionate claim on the assets and earnings of that company or corporation. Stocks are also referred to as shares or equity. A shareholder who owns stock owns a portion of the company equal to the number of shares held as a percentage of total outstanding shares. There are two types of stock: common stock and preferred stock. Equities refer to common shares with a much higher market value and trading volume than preferred shares. The main distinction between the two is that common shares typically include voting rights that allow the common shareholder to participate in corporate meetings and elections, whereas preferred shares do not. Preferred shares are so named because preferred shareholders receive dividends and assets before common shareholders in the event of a liquidation. The stock market is where investors buy and sell company shares. It's a network of exchanges where companies trade shares and other securities. Individual and institutional investors trade shares on stock exchanges in a public setting. As buyers and sellers place orders, supply and demand determine share prices. Specialists or market makers frequently maintain order flow and bid-ask spreads to ensure an orderly and fair market. It is critical to understand that corporations listed on stock exchanges do not regularly buy and sell their own shares. Companies may conduct stock buybacks or issue new shares. Still, these are not routine operations and frequently take place outside of the framework of exchange. So, when you buy a stock on the stock exchange, you're not buying it from the company, but from another existing shareholder. Similarly, when you sell your shares, you do not sell them back to the company, but rather to another investor. A capital gain occurs when you sell a stock for a higher price than you paid. A dividend is a portion of a company's profit distributed to its shareholders. Dividends play an important role in stock returns. Since 1956, they've contributed nearly 1/3 of total equity return, while capital gains have contributed the other 2/3. So, the stock market is an excellent place to begin if you want to invest.